I got a list. Here's the order of my list that it's in. Investment advisor, wealth manager, financial advisor, asset manager, certified financial planner, chartered financial analyst, chartered financial consultant. I'm not even halfway done. Portfolio manager, financial coach, financial therapist, broker, stockbroker, broker dealer, money manager, hedge fund manager, venture capitalist, private equity. He works in private equity. They always say that one. Registered investment advisor and fiduciary. Did I miss any?
A lot.
There's more? Welcome to It's All Money. Your hosts are right here in front of you. We're checking out It's All Money. Welcome inside the Sonoma Wealth Advisors Conference Room on the Sonoma Square in Sonoma. That's Sonoma 3 times. My name is Dano Weir. I'm your host and the Director of Marketing for Sonoma Wealth Advisors, joined by 2 guests today. Chris Sipes, CFP AIF, the Managing Principal of Sonoma Wealth Advisors. And a round of applause for the first time in the podcast, Rachel Schuyler, our Director of Growth.
Happy to be here, Dan.
We are talking about the F word today. Funeral. No, not funeral.
Friday.
But funhouse.
Not that F word, right? If people have kids in the car, they don't need to turn it off.
No,
Right?
it's a joke. On YouTube, you have to do something that catches somebody's attention.
Yes.
Fiduciary. We're talking about a fiduciary, and specifically, we are talking about the different names and models in the industry of finance. Because one of the goals of the show is demystifying this entire industry and letting our listeners, our viewers decide what works best for them. Mm-hmm. And as you heard from that first list, there's a lot, and it's very confusing. Both of you have experience in a lot of these areas, and so that's why I wanted you on the show today. So we're talking about what is a fiduciary and all of the other different names that there are in the industry of finance. So, Rachel, in 100 seconds, tell me your background in finance.
Let me see that list again. All right. So, began my career in asset management. I was a
ding. All right.
A wholesaler. So essentially,
you're a wholesaler. Ding.
Yeah.
We'll add that to the list.
Yeah.
Essentially, I sold financial products to financial advisors, and it was not very fiduciary-esque. We'll put it that way. Commissions were what we were after. So it was really not in the client's best interest.
And we'll get a deeper explanation later in the show, but just right off the top, the word fiduciary means in the client's best interest.
Yes.
Right.
Keep going.
From there, I moved over to Zoe Financial, which is a fintech startup, which the whole mission was to protect consumers from the brokers of the world and connect them with a vetted network of solely fiduciaries, which we'll get to that in a bit. But yeah, it was very altruistic, and we helped people, we genuinely helped people get good advice. And now I'm fortunate enough to work for Sonoma Wealth Advisors, a registered investment advisor, along with many certified financial planners also on the list. And we are a fiduciary, so we are legally obligated to act in our client's best interest.
I think we have to say we have fiduciaries on staff because the firm itself actually cannot be a fiduciary. Mm-hmm. And I'm not even a lawyer, Chris.
Wow.
This is the on-the-job training.
You should probably become one, because you are
charge
in charge
a lot
of marketing.
More.
And I think marketing requires a law degree these days.
These days, it sure does. Rachel, thanks for sharing that. Chris, yourself, obviously, you're the managing principal now of an RIA, a registered investment advisor. Mm-hmm. But prior to that, you were?
I started out my career in the insurance world, specifically commercial insurance. Went from there to a large bank that also had a broker dealer attached to this bank. So like Rachel, I've kind of seen the different, types of financial advice that's out there and what's available in the market, and kind of seen it from the inside. So
So let's start with this. I want to I want to talk about the word broker because we'll be saying that a lot today. So I did. Chris is here. He's big on history. So I had to do some history for Chris.
That makes two of us.
The word broker derives from the Old French Brocceur. Mrs. Gould at Casa Grande High School is going to kill me because I won't say this right. I think it's brocheur, which means small trader. It's uncertain origin, but possibly from Old French, also meaning wine retailer. And that comes from the online etymology dictionary. Also, Oxford English Dictionary says that the word stockbroker dates back to 1706. That's the earliest evidence they have. All right, more history, Chris. So
Yes.
this is important. So from my reading, the model kind of went like this. You have Jill Public wants to buy a stock. They need someone in the middle who's going to buy that for them.
Correct.
And that person is paid on that transaction. That's their commission.
That's right.
And that is the model as old as time.
Yeah. And,
Okay.
and there's various versions of that, right? There's like what they call a broker dealer, where they're going to get a whole inventory of stocks or bonds, and they might sell to big institutional investors. And their job is to make a market, which means, just like it sounds, be the buyer or the seller when people need to buy or sell. And then you've got other models where, say, a company was wanting to sell stock in its company. They might go direct to the public and say, "Hey, I've got shares in this company. Here's the share. Here's what this company is about. You can buy shares for this price," and people would buy from them.
Can I add to that?
Of course.
So, big part of my job at Zoe was educating consumers on all of this. And like broker, to me, it all goes back to incentives. So they're incentivized to sell products that puts money in their pockets.
Mhm.
So that's obviously not in anyone's best interest, but their own and the firm that they work for. It's very transactional. So I would summarize it.
So that transactional business model was kind of the standard. And this is coming from a great write-up I found on a website called analyzingalpha.com, also which had sources in the New York Times. 1975, the SEC deregulates a 183-year-old law that had 2% fixed commission rates. Which basically they deemed to be keeping people out of investing because it was too expensive to buy one stock every single time from this one person. Okay, same time, you've got Charles Schwab and T.D. Waterhouse coming to prominence. Public participation in the market starts reaching record levels. Commissions that were averaging 80 cents per share in the early 1970s plunged to an estimated 4 cents, right? And so I identified this as the moment where you suddenly go, okay, well, the money's been goofed with the way that we've been doing it for a long time. So now, well, I'm going to set it up like this. Well, I'm going to set it up like this. Well, I'm going to set it up like this. That's what, from my reading, I kind of identified. And so I want to talk about the different ways in which 3 different types of financial advisors are paid. So let's go back to the broker model. So I'm a broker or a broker dealer. Chris, how is a broker dealer paid? Once again.
So broker dealers, those are the ones who are typically making the market. They're making the trades. So they make money in several ways, but the chief among those is the spread between the bid and the ask, which is if I buy it from you at, say, $100, and then I sell it to Rachel for $100.02, I make 2 cents on that transaction. That is the primary way a broker dealer would make money.
Okay, so the broker dealer is incentivized if in the scenario you're just giving, where Rachel is our client, you're incentivized to sell that client a product.
Transactions are good for broker dealers.
Correct.
Right? Transactions is where they're making the money. Now, there's also other arrangements with certain fund families where the fund family will pay what they call
Fund family is a what?
revenue share. Okay, so
Mutual fund for shop asset manager,
Okay.
right.
like
Right.
like Invesco or
Okay.
There's
PIMCO.
all different mutual fund families, right? And some of them,
So the broker isn't even the person with the fund. So you've got the mutual fund, and
sometimes they do. Sometimes they have their own.
But in this
funds as
scenario
well.
that you're talking about, you've got a
Yes.
mutual fund, which is a company which says we think we can pick the best stocks. Super general. We think we can pick the best stocks, throw them all into a big salad, and then sell that salad to the broker dealer, who then sells it to the client.
Close.
Almost.
Cancel the episode.
They'll say, here's our menu of mutual funds that we work with.
Yes.
Right. Or investments that we work with. And so the advisor or the client can pick from that menu. When they pick from that menu, a certain portion of that revenue goes back to the broker dealer. So they're kind of, in a way, paying to be on the menu.
Can
Interesting.
I give you one example? So we sold a lot of bond funds at another asset manager. It was A shares, which is an upfront sales charge. So I, being Series 7 license, was allowed to, provide advice to advisors. It was 5.25% upfront, and then there was a 12B1 fee baked into that. So that's like another 1-2%. So yeah, we were very much incentivized to gather assets in the products, if that makes sense.
And now the broker would say that these fees are very important because they've got a business to run,
You gotta
right?
keep the lights on.
So you got to
True.
keep the lights on. We have property that we have to pay for. We have
Pay for the-
insurance that we have to pay for. Got to pay for our portfolio managers.
Yes.
Right. But then there also has to be upside in it for them. They're not running a nonprofit, right?
Oh.
So then how much are those fees really in relative to whether it is or isn't a good value or an overcharge? And you, as the client, might not necessarily know that.
Right. The C-suite was very well paid. Correct.
I think that's an important thing to say, is that if you are a client shopping for, a person to work with, whenever you're looking for financial advice, you should 100% be crystal clear on how that person's getting paid and who they're getting paid by. It's not out of line to ask that question.
No way. Yeah.
You should know.
And back to you brought up the menu of mutual funds that you might have at a broker dealer. So if you're a client working with a broker dealer and they show you the mutual funds, you are in that case picking. But it also should be noted that those are not the only mutual funds in the world. And in fact, you're looking at one corner of the universe, and
One
there
family.
are
Yeah.
a ton more.
Right.
Yeah.
So you're looking at limited options.
At one given fund family. Yeah.
Yes.
So ideally, you want to diversify across multiple families. Although, then you don't hit the break points with the fee cut. But
Break points is when you have a certain amount of money with one fund family, then the fees come down.
Right.
Right.
Okay.
So
I'm following.
are you?
I think. See, the benefit is I'm not licensed. I'm just the marketing director. So I'm closer to you watching this show than Chris is. Chris really knows this stuff, and I'm learning this stuff just like you are, Rachel as well. So I want to
I think the point is, so far we've got two areas of where this broker is being paid from: transaction and fund families.
Correct.
So far. So you can already see that there's not like one clear place that this entity that is giving you, their recommendations or whatever, where they're getting paid from. There's several different areas. Right?
Yep. So here's a little fun story for you that I think will help illustrate this. So we used to celebrate and take out to golf scrambles, steak dinners, the advisors that would send the most, that gave us the most commission, that's clients' money, right? So the fact that we were celebrating that and rewarding them for that is in retrospect very, very twisted, if you think about it. I didn't know any better at the time. I was 22, so put it against me.
And I think, and I want to be really careful today, because on this show, we are always careful to present, up and downside, right?
Yeah.
And so again, the broker would say, but hey, you're paying fees on the transactions, but you're not paying that ongoing fee. You don't have a subscription fee to us, right? So there are people who, when we're going to talk about RIAs now, oh, the fees, what are you even paying for? You're paying that every year, right? And so to someone who that's a real pain point and that just drives you nuts, maybe paying per transaction really is right for you, but it's up to you. And let's talk about the next model here, which is the registered investment advisor.
Yeah. So the good thing about RIAs, that's the acronym for registered investment advisor, there's flexibility with fees, I would say. So when I worked at Zoe, I heard every fee structure that existed, and it ranges from hourly to a subscription or like retainer. So it's monthly or quarterly installments essentially, or they charge based on assets under management, which I think it's a lot different because, when the firm does better, the clients do better. So again, going back to incentives, we're all incentivized to do well for our clients.
All right. So you said firm does better when the clients do better, and assets under management, AUM. So with an RIA, the structure is, let's just say, it's not true, but let's say I had $1 million and I'm going to invest it with Rachel, the RIA. How do you get paid?
The three that I just mentioned, that's how I would be paid.
Most common is the assets under management or assets under care model, which is typically a percentage based on whatever that advisor's structure is. The most common is 1%. So let's say 1% is the fee on $1 million, so that if that fund grows, then the dollar amount will change with those funds up.
Mm-hmm.
Same thing, it will go down. But in that situation, the client is hiring the investment advisor as their guide, as their fiduciary, and that client that client's management fee is the only source of income to that registered investment advisor. So you, Dan, would be hiring me as your agent, your fiduciary,
mm-hmm.
and I'm working for you. You're paying me, and that's it.
And that's what I was looking for, Rachel. I'm sorry, I should have specified numbers. I was trying to play the numbers game out. So the 1% scenario, right? So if that investment grows from 1 million to, let's say, 1.1 million, well, now I'm paying you 1% on 1.1 million, but I've also made I've made $100,000.
Unless you hit a break point. So let's say it grows to $2 million, that 1% may come down to 85 basis points, right? So that's what I meant by the client does better, the firm's doing better. So yeah, it's very much aligned.
It's negotiable.
Yeah, I guess everything in life is negotiable.
Right.
Yeah.
And you also, in addition to upfront fees, you also, as an investor, have access to a wider world of investments.
Yes.
Can, not always, right? But usually. And it's and a lot of times, so those same mutual funds that we were talking about earlier, they have different share classes. So you can have the exact same fund with the exact same underlying investments. So Fund A, and it owns these 10 stocks, let's say, that will have different flavors depending on who you buy it from. And when you're with an institutional investor like us, which is a fiduciary, we buy the share class that is typically the cheapest, because there's no portion of that comes back to the RIA. So going back to that revenue sharing before, where some of that money had to go to the broker that sold it,
mm-hmm.
that doesn't exist with the RIA structure.
Yeah. So I mentioned the A shares, 5.25% upfront.
Mm-hmm.
The institutional share classes that we use, there's no upfront fee. So yeah.
It might have A shares, C shares, F shares. There's all different, and they all have their own corresponding expense ratio. That's the expense of the actual fund
mm-hmm.
to run it.
Mm-hmm.
And but again, it's the exact same fund. It's just, where are you buying it from? And to your point earlier, sometimes, let's say you're going to buy that one share, and then you never want to talk to an advisor ever again. You don't want any financial planning. You want no advice. You're just going to own this share of this mutual fund for 100 years. Maybe that A share that you pay 5.25% up front is the best thing for you. So there's definitely a spectrum. It's gray, and there's not always a situation where this is always the best way. Right?
But we also, we are a fiduciary. We are a registered investment advisor, so we clearly are fans of it. And you are getting. You mentioned the planning piece. So can you explain the difference between asset management and financial planning, Rachel?
100%. So asset management does not involve, at least in my experience, does not involve financial planning. So
now you blew a lot of people's mind there, because I think a lot of people just kind of conflate the two. So
well, that's the thing.
What's the difference?
I'm pretty sure that the average consumer is extremely confused, because now everyone says they do financial planning, but financial planning means different things to different people and how they market it. So
okay.
Asset management is all about investments. So when I interviewed a lot of advisors at Zoe Financial, I wouldn't let them in the network if they were leading with investment performance. Like, you need to be leading with financial planning. Otherwise, the investments don't make sense. How are you going to make sense of investments without an actual plan? So that's a very big difference between this world and that world.
And financial planning is
valuable. What is this?
Define. I'm looking to define. I'm looking to define the difference for someone. So asset management is hey, you gave me $500,000 and I bought Pepsi and 3 other stocks.
So asset management, most of the time, it's a portfolio manager who's managing said mutual fund. Whereas Chris, our wonderful CIO, is running our models here. So portfolio managers obviously are investment heavy. They're not doing planning either. So
okay,
planning is more, in my mind, more about getting to know what it is the client wants to do with that money, right? Or how much they would like to have in the future. What are their plans? For the future. So getting to know Dan, his situation. I want to be retired by 50. I would like to spend about this much every year. Those types of things. Okay, well, how are we going to get you there from here? That's planning. Now, part of that is you've got to have investments to do that, most likely. And so, okay, well, we're going to work together to figure out what's the best investment plan to serve that plan. Now, it's not exactly asset management, because when I think of asset managers, I'm thinking of the people that are running the mutual fund, they're running the ETF, they're running whatever hedge fund. They're the ones that are in the weeds studying, is it better to buy this stock or that stock, or this bond or that bond? Because that takes an incredible amount of time and resources. And most advisors are going to be picking amongst those funds to come up with an asset allocation that makes sense for the client.
Right.
So the financial plan is basically the roadmap for the person.
Yeah.
The financial plan is, I want to retire at 65. That's in 17 years. Therefore, I need to think about this from a tax strategy standpoint. I need to think of, I want to move to Idaho and buy this house. Okay, I'm going to need this amount of money and
I'll use it. I like to use analogies. So if you use like a fitness analogy, right? If you go to somebody and say, I want to run ultra marathons. Okay. The plan for that is completely different than I want to compete in bodybuilding competitions. Okay. So you're going to need a different plan for each one of those routes. Well, you're also going to need to eat food. So you're going to have probably a wildly different, nutrition plan based on which one of those routes you're going to.
All right.
Okay. So I'm going to say, well, you're going to need, this much meat, potatoes, and vegetables. And then, but somebody else is making that meat. Somebody else is making those vegetables, right? We're not actually doing that.
Right.
But we might say, hey, we like these brands. They create the type of food we're looking for.
You're guiding.
Example.
You're the guide.
Yes.
I mean, I think it's also easy to think of it as like, not every client is the same. So like, we have a lot of younger clients. They're going to have different investments. They're going to have different asset allocation than someone that's 80 years old. So you would never know any of that if you were just doing investments.
Now I'm preaching to the choir here, but how could you ever know how to put someone's money somewhere in an investment if you didn't know what the plan was?
Exactly.
Sorry.
Exactly.
Well, that,
I mean, yeah,
that goes
that's
back
like
to
come
the
full circle.
component.
Yeah.
yes,
Yeah.
and that goes back to the obligation as
Fiduciary.
or not.
Mhm.
You know, maybe you don't care about any of that. Maybe you just say, "Hey, I want cake. I want this kind of cake, and I need somebody to buy it for me."
Right.
Right. And that's fine. There's a market for that. There's
Yeah.
people that need that and want that, and so that's why it exists.
All right, let's move on to the third type here, insurance. So, Chris, you mentioned you did have some experience in that earlier in your career. How are insurance agents who are also financial advisors, how are they paid? Some of them try to say, I've heard that.
Well, there's a lot of different types of insurance. Obviously, there's everything from home insurance to insurance that are like quasi investments. So, you know, and the insurance industry, I feel in general is like kind of behind most of the rest of the industry in terms of how it works and how people get paid. That is changing. Like they're allowing different types of pay structures, but the vast majority of it was commission based.
So similar to a broker dealer. I get paid
Sort of.
when I sell you a policy.
Yes. And then within there's independent agents where they can buy from all different kinds of companies, but company A pays this commission, company B pays a different commission. They're going to have different policies, different prices. Then you have captive agents, which they can only sell you from one company,
Right.
right? So you can have anything you want as long as it's from them, right? So there's different ways. And to your point earlier, there's a lot of different people that say we're planners, we're financial.
Because some insurance products do have investments rolled into them.
Well, there's a lot of them are built as tools for certain parts of plans.
Rachel's ready to go. She's like bursting.
Help me out, Rachel.
Well, so the captive piece, I think, is important because if it's how it sounds. If you're held captive to said insurance firm, you're only allowed to sell policies, which that's a huge conflict of interest. Like, what about diversification? You know, it doesn't exist. Whereas if you're not held captive, if you use like an FMO, which is field marketing organization,
maybe
they'll give you a variety of quotes from different providers, a little bit more agnostic. So I think that's in my humble opinion, a little bit less of a conflict of interest than having a one trick pony essentially.
But it can be hard to know. That's the
Totally.
goal of today's episode is that it can be hard to know, and especially if you're the dad in the family or the mom in the family, you're the one who's in charge of the money if you do that, or maybe you're both working on it together and you're trying to do what's best for your family, and you go and sit down with somebody and they seem nice and you have no clue what any of this is, and you've waded yourself into a whole life policy.
Yeah.
And maybe that wasn't the best thing for you.
It could be, right? I don't think there's ever a time where you can say it never works as the best tool. Like there's always a situation, right? But there's this nuance between fee-only advisors and fee-based advisors. Now we're a fee-based because some of us in the firm have an insurance license, and some insurance can only be sold or paid for in a certain way, right? So it doesn't, because of that, you have to say that you're fee-based versus if you don't have an insurance license, you can say that you're fee-only, right?
Okay.
So,
on a positive note regarding insurance, aren't there now fee only, like DPL? Is that DPL, like fee only fee structures?
there's a lot of companies out there now that are offering the fee so that it's basically the same whether the person buys an insurance product or an investment product.
Yeah.
So that the advisor gets paid the same, which is great. And I think that's a huge point we were talking about earlier is there's never been a better time to be an investor. The types of investments that you can get for the price that you can get them at today, the quality of advice that you can get if you look for it is so much better than it was 10, 15, 20, even 30 years ago. To your point about the regulation being changed, I mean, it was so much more expensive for so much more of a limited spectrum of options than what we have today. So it is evolving. It's always getting better. It feels like, in terms of the options that are out there.
Okay. Yeah, and the technology too.
And the technology, yeah.
Chris, can you give me, because today's episode, the title is the F word, fiduciary. Can you give me some of the key components of a fiduciary? We've touched on it generally, but it's in the best interest of the client. What does that mean? And is that just something you say, or is that something you studied and passed tests for?
I'm sure there's lots of different, definitions for it. I like the one from the CFP board, the Certified Financial Planning Professionals Board. They have the duty of loyalty, care, and the duty to follow clients' instructions. So that's how they define it. I think those pretty much speak for themselves, but loyalty, obviously, if you hire me as your agent, I need to be loyal to you and do what's in your best interest, as if I was making the decision for myself. And I think the best concept I can think of, just to make it super simple, is if you were managing money for a child, say you're managing money for a 3-year-old, my 4-year-old, he doesn't know anything about money. So, but let's say he had $10 million that somebody needed to manage. So you would be managing it on his behalf, in his best interest. So what would you do, knowing what you know, to help this person? So the duty of care is doing that in a way that, you're thoughtful about it. You're professional. You recognize when you are in a zone where you maybe don't know the answers and you need to bring in somebody else that does, when you've reached the edge of your competency levels, right? So being thoughtful in how you provide that, and then lastly, following the client's instructions. At the end of the day, as long as that client is, mentally competent, you can give them all the options and they say, yeah, thanks, but no thanks. I still want you to do this. You have to do it. You have to act on their instructions.
But they're paying you an upfront fee, and that's what I mean. There's no, if they buy something silly, well, maybe something that's risky, or that is. What's that?
Bitcoin, right?
Don't tell Darren. If you buy something that you wouldn't necessarily advise, that's up to them, and they've still paid you the fee, right? They paid you the fee that you gave them the advice, and then they said, thank you for the advice. I still think this is a good idea, but maybe that adjusted their opinion or whatever.
Correct.
Versus, telling them, I really think you should buy this stock that when you buy it, I'm also going to get paid.
Wink, wink.
Yes. Well, yeah, I mean, as a parent, I think you can understand how I'm putting this, but like sometimes things that you're trying to relay to your kids, but sometimes they're only going to learn it the hard way, right? Put your helmet on before you get on your bike, right? And they're thinking, God, what a drag, Dad. I don't like that, and then so maybe they don't follow your instructions. They fall, they hit their head, so there's a lot of situations like that where, you try to give the best advice, but ultimately it's up to them if they're going to put the helmet on or not.
Yeah. Learn by doing.
And for us, unfortunately, if they say, you know what, I reject the helmet, send me down the hill with no helmet, ultimately we have to say, okay, here you go.
Well, Rachel, you've been with us for a while now, working for a fiduciary. How has that been different in your career?
It's a night and day, honestly, compared to going back to your list. I mean, the asset management world was very transactional. It was almost a little gross. And again, no, I'm not shaming that part of the business. My husband's in that part of the business, in fact. But with the RIA structure and the fiduciary obligation, it's not like we're faking it. Like we're genuinely, we care about our clients. We do what's in their best interest. We help them reach their goals. I would say it's a lot more fulfilling overall. Like you leave work and you feel like you did good by people. It's very different than, hey, like I sold the most short duration income today. Like I get to go on the golf scramble next week. It's just it's drastically different. So let's just say I'm enjoying it.
I think golf courses were invented when brokers
Yeah,
came around.
100%.
All right, hot take. Sorry, guys. Thank you both so much for joining us today. And thank you for checking out the show. Hope you learned something. And if you didn't, watch it again.
And hit that subscribe button.
We'll see you next time.
This content was produced by Fermata Advisors, LLC, an SEC-registered investment advisor. DBA, Sonoma Wealth Advisors. The opinions expressed by Fermata Advisors, LLC on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.